Okay. Hi, everyone. Why don't we just get started? I think there are still some people probably getting on, but I want to be sensitive to everyone's time and, I want to just, the first class, so I want to make sure we get through everything. So welcome to Biz 133. It's called Timeless Strategies in Value Investing, Lessons from the Legends. I guess just right off the bat, I want to make sure that we're not having any technical issues. You can hear me, you can see the screen, you can see the slides. Just a thumbs up or something, just let me know. Okay, great. If anything happens along the way, please feel free to stop. So let me just kind of walk through the plan. So today, my plan is, I'm going to give you kind of a quick introduction of who I am, first and foremost. We'll talk about the readings. Hopefully you guys have a chance to go through them. I'll then talk just kind of quick takeaways, and then I'll leave time at the end for Q&A. So really, first, who am I? Like I said, I'm your instructor. My name is Jack Bogle. I have 25 years of investment management experience. I started my career at Goldman Sachs in equity research. Afterwards, I worked for 3 different hedge funds. I worked for a fund called Stark Investments. I worked for a fund called Columbus Hill. And then I worked for a fund called Appaloosa for 13 years, where I was a partner. And then more recently, I started my own investment partnership called Solaria. And I also manage a family office called Versica. I've been around for a while, so I've seen a lot of different markets. I've seen booms, I've seen crashes. So I feel like I've probably had enough experience to hopefully make this class informative. Right off the bat, I want to be very clear. This class, Biz 133, is not meant to be a traditional investing class. In the sense of, we're not going to be talking a lot about accounting. We're not going to be talking a lot about financial statement analysis. The focus is really on understanding how we want to be thinking about investing. By no means do I say that it's the only way to invest, but I think what we're going to talk about over the next 8 weeks will hopefully give you a very good framework on how to think about investing. And any of you guys who haven't completed the, I had a week 1 assignment, which is just literally send me a 2 to 3 sentence email through Canvas to let me know who you are and what you want to get out of the class. I just want to get to know all of you guys, and we'll hopefully be able to tailor the class more to what you guys are specifically looking to get out of it. In that same frame of reference, I really want this class to be a discussion. So obviously, I'm going to be spending a lot of time talking, but please use the Zoom tools. If there's a question, you can raise your hand, or you can put a question in the chat, or just feel free to interrupt me if I'm speaking too fast or something isn't clear. When it comes to the readings, there's also Canvas, where you can submit questions before class, which I'll look at in the discussions. Anytime you have a question afterwards, you can also submit it on Canvas, and I'll make sure to look at it. So roughly, the way I sort of have thought about it in my head is, we have about 90 minutes. I'll hopefully, really use only about 60 minutes to kind of talk through the slides and things like that. And I'll leave, roughly 20, 30 minutes at the end for discussions and questions. So just, I'll pause there for a minute if anyone has any questions right off the bat. Otherwise, I'll get started. Okay. So,
hey, Jay,
yes.
quick question. That assignment, is it in Canvas? Because mine is completely empty, or was it an email?
It should have been in Canvas. I mean, I've gotten a few, so it should be in Canvas. And if it's not in Canvas, I'll go back and check it. But all you really need to do is just go to Canvas, go to the inbox, and just send me just a little message telling me about who you are and stuff like that.
Thanks.
Yeah, no problem, Wesley. So let's first start with the problem. What's the problem? The problem is, hold on. Problem is I can't get my mouse to work. No, the problem is we want to be active investors, but most active investors underperform. Here is, I think this is an interesting chart. Interestingly, this chart comes from the chief economist from Apollo Global, which is itself an active manager. But basically what you can see in this chart is, and this is looking at equities and fixed income globally, but over 10 years, the average manager underperformed, 90%, 85, 90% of managers underperform their benchmark on the long term. What this chart doesn't talk about is taxes, and we'll see later on that pretty much everyone underperforms after taxes. So the question is, why do these active managers underperform? Maybe they're just not very smart, could be. Maybe they're not very skilled. Maybe they just don't have information. But the reality is, I think the answer is none of those. So why do most active investors underperform? Number one, active management before fees earns the market return. We'll talk about that in a minute, part of the readings. Number two, there are significant costs related to active management. And then thirdly, and maybe the most important one, is there's not enough, for lack of a better term, quote unquote, dumb money left in the market. So I think we'll see that these are probably the more likely answers. So I guess, should we all just go home and call it a day? This will be a very short class. I am myself an active manager, an active investor, so I think the answer is no. But I also do think that we need to understand the problem if we're ever going to solve the problem. So let's talk a little bit, before we get into the readings, I want to talk a little bit about what the evidence looks like. So there's a report called SPIVA, which is an acronym for the S&P Index versus Active, and it's published semi-annually by Standard & Poor's. And what they do is they compare actively managed funds against benchmarks. They track this performance globally across equities and fixed income, and they do an important service because they account for funds that close or merge, which is called survivorship bias. And what does the SPIVA data show us? Well, it shows us that sustained outperformance is very difficult. Most funds will underperform both on a single year and over the long term. You have better odds in Las Vegas than an active manager has outperforming the benchmark. Now, I have to be very careful. That's a joke. You do have better odds on a single hand in Las Vegas than your active manager has outperforming, but you should probably not gamble because over time you will lose money. So let's look at it kind of just real quick. I'll kind of try to zip through some of this stuff. So here we are in the US. This is, I think, the most recent data. But what we see here is that about 90% of funds underperform the benchmark. You can look, there's small cap, mid cap, growth, value. The numbers are pretty bad. Pretty much no place to hide. Canada, around the same 90% long-term underperformance. Maybe a little bit of opportunity in small and mid caps. Only about 82% of those guys underperform. LATAM, slightly better, but still not very good. You'll see a couple of numbers that maybe look a little bit promising, but those are the Brazilian index, which is dominated by banks, miners, and oil companies. And so it's pretty easy to outperform if you just underweight those indexes. Let's go across to Europe. We see sort of the same thing. Pretty bad numbers. These are all numbers for underperformance. Japan, actually, interestingly, this was surprising to me when I was putting this together, does look a little bit better. And then when you dig into it, there's maybe a little bit of explanation. One is there's a lot less analyst coverage of small and mid-cap companies in Japan. So maybe there's a little bit more opportunity that's uncovered. And then what I think is really the better explanation is that there's much greater retail investor participation in Japan. And we'll talk about why why that matters.
Hi, Jay. Sorry to disturb you. I don't think I'm
Yeah.
seeing anything being presented.
No, it is there. You have to
Is
click
it?
on Jade's his screen. It's one of the tabs. But Jay, we're
Oh,
seeing you actually two times. On your screen, we see your image, and we also see you among the speakers.
okay. So people
Okay.
are
So
seeing it.
I'm in sharing mode, so I don't really see it. So hold on. Let me just stop the screen share for a second. And okay. So let me try to do it a different way.
Yeah, I think now it's working for me. Thank you.
Okay, yeah, sorry about that. Okay, Judy, was there anything that you didn't see that you want to go back?
No, I heard you. I thought I didn't see it, but now I see it. Thank you.
Okay, yes, please, and please, if like I said, if I make a mistake or anything on Zoom, please feel free to interrupt. Anyway, so here we are,
Sorry, Jay.
Japan. Yes.
Somehow your screen has shrunk, like the presentation mode.
Got it.
Yeah, I sent a
Okay.
screenshot in the chat, Jay, of what it looks like.
All right, hold on one second. Let me go to the chat. Okay, hold on. Here, let me try something else. Different. I'll go back to the way I was sharing it before. Let me just, hopefully that works again. So I was doing a screen share of a portion of the screen. Okay, how is that now? Is that, everyone can see that? Yes? Okay.
No, we see just a portion of the screen. It's just part of it. It's not the whole screen.
You can see the whole screen, but the numbers are too small to read.
Yeah, it was fine. No,
Do you want me to go back to the other way, or which one is preferred, I guess, is
the
really
first
the
one was
question.
good. The first one was okay. Then you did a reshare, it becomes smaller. Now it's just very.
You know what? Okay, here, hold on. Maybe I could do something else. Sorry about that. Here, I will shrink my screen and then I will make this one bigger. Let's see if that helps at all. Sorry, growing pains for the first class. Hopefully.
Another suggestion, maybe just send the presentation, the deck, online so that people can access it. There's always some problems with Zoom.
Yeah, that's a good idea. Okay. Is that any better?
Much better. Yeah, it's much bigger now.
Okay, great. So see less of my face, which is probably a good thing, and more of the screen. Is that good for everybody? I just want to make sure before I go.
Fine. It's
Big
fine.
improvements.
Big. Okay, great. Thank you. I will make sure that I keep this setting for the next class. So anyway, so here we are. We're talking about Japan and why maybe there's a little bit more opportunity in Japan. But you know, the point is that all the performance I just showed you is before taxes, and after taxes, you'll see that it basically becomes nobody outperforms the index, the benchmark. Here's the same chart for the US, but after taxes. And you'll see that both on a 10 and 20-year basis, about 98% of funds underperform. So, begs the question, why does almost everybody perform so poorly? But before we get into that answer, usually I get asked, well, what about hedge funds, right? You come from the hedge fund industry, so what about hedge funds, right? They are smarter and more sophisticated, maybe. They can trade both long and short, right? They can buy stock, they can sell stock and then buy it back, which is, shorting. And they, supposedly are more nimble in terms of entering and exiting markets. right? I think probably questionable. So let's look at the data. So there's an index called the Barclay Hedge Fund Index, which is perhaps the best source of data. I think it's been around the longest. It's been around since I think 97. What's interesting about this index, though, is it is subject to survivorship bias. Only funds that voluntarily report their returns are included in the index. So if you run a fund and you have a bad month or you shut down, you stop reporting. So the index is sort of biased on the upside when the numbers are not, if you have bad numbers, they're not included. But what do we see? Well, hedge funds navigated the tech bubble fairly well. Here is the full, I think this is the full time series data. So if you look basically from 97 till 2000, the peak of the tech bubble, the hedge fund index, the yellow line, and the S&P 500, the red line, kind of stayed 1 for 1. And then from 2000 to 2002, hedge funds kind of stayed flat and the market went down a lot. So they really protected capital. And really, you're only at this point now where, the S&P 500 is starting to outperform the hedge funds. So if you had invested in hedge funds since 97, maybe you don't feel so bad. Again, ignore for the fact that the hedge fund index is probably a little bit overstated because of the survivorship bias. They also did okay did better through the GFC. Here's the same chart. If you look at starting in 2002, so sort of the bottom of the tech bubble, they kind of kept track until the GFC. They lost less money than the GFC. And then really, hedge funds were outperforming the S&P until about 2012, 2013. And then since then, the S&P 500 has trounced the hedge fund index. And you can see this. So since the end of the GFC, basically it's, hedge funds haven't done nearly as well as the S&P 500. Why is this the case? Well, hedge funds do well when markets decline because they have less than 100% market exposure, right? They short stocks. They will get in and out of the market. They'll have less cash in some cases. The problem is that markets rise over time. So lower exposure tends to lead to lower long-term returns. Now, the promise of hedge funds, or at least the marketing of hedge funds, would say that, well, we can select stocks, we can time, and we also use leverage, which maybe they don't advertise as much, and use those things to overcome the lower exposure. But in reality, the data does not seem to support that. So now let's get to the real question. Why do most active managers outperform? And so the first person we're going to talk about is William Sharpe. He was a former professor emeritus at the Stanford GSB. He developed something called the capital asset pricing model. And he has a ratio that everyone likes to quote called the Sharpe ratio, named after him. I believe for the CAPM, he won the Nobel Prize, and he's written a couple of books. And so the article we read, or hopefully you read, is called The Arithmetic of Active Management. And it's, I think he says it's, something like blindingly simple. But the point he makes is basically the return before fees for active management has to equal the market return. And why is that the case? Well, the market is basically two types. It's all the active investors and all the passive investors. And so what do you have? You have, think of it as, three pieces of the pie. You have the passive, you have active investors who outperform, and active investors who underperform. Passive investors have to earn the market return. And then all of the active managers as a group also earn the market return. So if we paraphrase, one of the things that he says, which I think is important to really understand, but if active and passive management is defined in sensible ways, it must be the case that before cost, the return of the average actively managed dollar will equal the return of the average passively managed dollar, and after cost, the return of the average actively managed dollar will be less than the return of the average passively managed dollar. So basically what he's saying is after fees, The aggregate return of active investing is less than passive. Some active investors will beat the market every year, right? We look back at this chart, you'll see that there will always be somebody who outperforms, there'll always be somebody who underperforms. But the point is that to beat the market consistently, Sharpe makes the point that you need, again, for lack of a better term, this quote unquote dumb money. Here's what he says. It is possible for the average professionally managed dollar to outperform the average passively managed dollar after costs. But for this to take place, individual investors, he's using individual investors as this proxy for quote unquote dumb money, must be foolish enough to pay the added cost of the institution's active management by inferior performance. And we'll go, as we'll see later on, the dumb money is, frankly, no longer as prevalent and frankly not as dumb as it used to be. Sharpe makes a couple of other points also, which I think are important to understand. Basically he says anyone who says that active outperforms passive is just, they're making a measurement error. He says the average actively managed dollar must underperform the average passively managed dollar net of costs. He's again basically making just a mathematical argument. And any empirical analysis that appears to refute this principle is guilty of improper measurement. So you would think that Bill Sharpe is a guy who's really into indexing and passive investing, but it's actually not the case. You'll see in a minute, but if the market was 100% passive, nobody would be doing fundamental analysis and keeping markets, efficient and properly functioning. A market that was 100% passive would freeze, all companies' sort of relative positions in place because, every incremental dollar that came in would just be allocated based on where companies are currently. So why don't we just hear from Bill Sharpe himself? So I'll just play this as a 5-minute clip, but hopefully you find it interesting.
You suggest that people ought to invest more of their money through index funds and less through traditional actively managed mutual funds. What's the difference between the two strategies, and why is indexed funding a better approach for investment?
Well, that story came out of things like the capital asset pricing model. Not very complicated little mathematical models, but mathematical models nonetheless. But as is so often the case, you can find that you can get the same conclusion much more simply. And so let me just share with you. A number of years ago, I published a little op-ed type piece in the magazine of the Financial Analysts Federation. So basically 150,000 practicing investment people read this because it's their professional magazine. It was called The Arithmetic of Active Management, and it was embarrassingly simple. And the argument is it's very simple. Let me just play it with you, if I may, if you'll indulge me. Imagine that everybody in this room collectively hold all the securities in, let's say, China, since we have straight from China. It's not a very well-developed mind. That's okay. It'll work. And we're going to divide you into a third over here. You're going to be index fund managers. Got Jim in the right place. And over here, the 2/3 of you, you're going to be what we call active managers. I'll tell you what you do. What you do is really simple. You just find out how many shares are outstanding of every security in China. And if you've got 1% of the money, you buy 1% of every single company on the Chinese market. And you all do the same thing. You do research. You learn about companies. You study industries. You visit plants. Lord knows what you do. But you find the companies that are really cheap, and you disdain the companies that are really expensive by your lights. You do the same. You have different research. You have MBAs from Stanford. You have MBAs from Harvard, blah, 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 blah. So you do your things. And we call you active because periodically you change your mind and you sell things and buy things. So the brokers like you, and you get good seats at football games. Okay. Okay, so you guys are active managers, you guys are passive managers. A year passes. The total Chinese stock market returns, 10%. Before costs, what does Jim get? Quick. 10%. 10. Okay. What do you get? 20. What do you get? -5. Over there is somebody who actually short stocks, whatever that is, and lost 80%, what have you. So you guys are all over the map. Question, before costs, what is the return on the average yuan or renminbi in this side of the room? What is the average return before costs on the average yuan or renminbi in this side of the room? You got it. After costs, these guys are cheap. They don't know anything. They don't do much. These people are expensive. They've got degrees from prestigious business schools. They do all this research. And the difference is something like, well, Schwab just announced they've cut their index fund fees on a couple of index funds to 9 cents per year per $100. The average manager over here is going to charge $1 per year per $100. So after costs, the average yuan or renminbi over here must underperform over here. And here's the irony, if you sort of think that through and say, well, maybe I'll get the one who's so smart over here that they can overcome their costs and beat the market. But then again, maybe I'll get him. So let's all go over here. But then the whole system breaks down because we need these people to be doing their research and keeping the prices reasonably in line with prospects. So it's a kind of a public good problem in which these people provide a great service to keep markets reasonably well functioning so these people can ride for free. It's a free rider problem. And I've worried over the years that if I say this to too many people, some of these guys will move over here, but they never do. They never do.
Why don't
I mean,
they?
you read, I mean, look at all these. How many of you have seen, stock picking magazines? I don't care if it's Forbes, Fortune's doing it now, Business Week. Here's a hot manager. Here's a hot strategy. Here's what's going to win next year. Boom. So, boom. If markets would have to be crazy to make it possible for somebody to write an article in a magazine, let alone somebody to read an article that others have already read, and ex ante do better. Ex post, some of these people are going to beat these people, but ex ante, you're better off over here. But don't tell too many people.
You suggest.
So, anyways, I thought that was a good clip. So, I think he does a good job of explaining his his core thesis of why active managers overall have to underperform, and what that comes down to, and also why we need active managers. So it's a little bit of a dichotomy. So the second question is this. So we know that active managers, we just listened to Bill Sharpe. We know that active managers underperform by the cost, right? But, costs can't be that high, can they? Well, let's now talk about the next guy, Jack Bogle. For those of you who don't know him, Jack Bogle, he used to be the CEO of Wellington Management, which is a big active manager. He had a falling out. He got fired, and then he started a company called Vanguard, which hopefully many of you guys know. But Vanguard is effectively the pioneer of low-cost index investing. And then he also wrote a number of books over his lifetime. The article you read was one called "The Relentless Rules of Humble Arithmetic," and what Bogle's point is that actually the costs of active management are quite significant, and we'll talk about them. But we should really think about costs in two forms, right? I think about them as there's visible and invisible costs of active management, and costs are a significant drag on your returns over time. Bogle makes a point that active management must underperform by the amount of costs. So again, to paraphrase, no matter how efficient markets may be, The returns earned must fall short by the market by precisely the amount of cost they incur. It is the central fact of investing. What Bogle's doing is he's basically making the same point that Sharpe just made, right? He also says that the costs add up and are significant over time, right? And he says that because the returns what investors receive come only after these costs, that these relentless rules devastate the long-term returns of investors. So what Bogle does in his article is he actually goes one step beyond Sharpe and he actually breaks down the costs. Now that article was written a while ago, so we'll analyze it using more current numbers. But before we even talk about that, let's talk about what are the visible costs, right? So right off the bat, trading fees, right? Commissions, bid-ask spreads, right? So most of you guys probably have a retail broker who's taken their commissions to zero, right? Robinhood started it. I think Schwab, E-Trade, everyone has followed it. So retail commissions have basically gone to zero. And, if you are trading on the institutional side, I think if you want to trade equities, I think you can trade them for as little as 0.4 of a cent per share. So pretty low. So that's, we don't have to worry too much about commissions these days. Bid-ask spreads, what are they? Well, when you look at the price of a stock, you'll see actually two numbers, one a little bit lower, one a little bit higher. If you want to sell, you get the lower price. If you want to buy, you have to buy at the higher price. And what that is basically that's the difference is the money that the market maker makes for providing the service. That's the bid-ask spread. Number two visible cost is management fees. Usually, pretty much always, they're calculated as a percent of assets under management. I don't know why that started, but that seems to have always stayed the case. So, mutual funds, I think we're around 1%. I think they're down to about 0.4% nowadays. Hedge funds, we're known as 2 and 20. 2 was the 2% management fee. That's also started to come down a little bit. And then third is performance fees. Now, mutual funds don't charge performance fees, but hedge funds do. And hedge funds, the 20 was historically the performance fee. 20% of the return would go to the manager. So that's really what defined hedge funds. So those are the visible costs, right? So what are the invisible costs, right? Well, number one is something that Bogle calls fund lag, right? The return of the average stock in the index trails the return of the index. We'll talk about that in a minute. Number two is investor timing, right? What we talked about before. People get in and out after funds have done well, or, they get in after funds have done well, they get out after they've done poorly. They basically get out at the wrong times, get in and out at the wrong times. And number three, and probably the biggest one, is capital gains taxes. So just like I showed you with Bill Sharpe, I thought it might be useful to just quickly watch a short clip about Jack Bogle because he does a pretty good job explaining his views, and then we'll go into more detail.
Section or analysis. He's John C. Bogle, founder and senior chairman of the Vanguard Group, the nation's second largest fund company, and he joins us tonight from Philadelphia. Welcome, Jack.
Thank you, Tyler.
Nice to have you here.
Always good to be with you.
Great. Your Index 500 portfolio, now the second largest fund in America, has $55 billion or thereabouts in it as of the end of last month. Do you worry that so many investors who have put so much money into that fund over the past few years are going to be disappointed, not when that fund doesn't perform as well, but when some other index fund that you own starts to be the one that everybody wants to be in?
I worry about it a good bit. People should take an index fund for what it is, Tyler. This is a large cap oriented fund. There will be a time when small cap and mid cap funds will do better than large cap stocks, but it's not here now. And to my delight, it wasn't here in the decline. The index fund gave a wonderful account of itself when the market went down mid-July to the end of August.
Hey, Mr. B, Bill Griffith here as well.
Hi, Bill.
What about the big picture, though? I mean, you, more than anybody probably in the mutual fund industry, have been a proponent early on of index mutual funds, and people lately have been buying into them. But what about the concept that if we see a market continue to decline, that people will be disappointed in all index funds because they find that the managers are not allowed to sell to get out of the market?
Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market, and 4%, only 4% at the peak. They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock pickers market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock pickers market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one.
You know, we were talking last week on the program about mutual fund fees, how most people are happy to pay them when the market's going up because they're still making money. But as the market comes down, and especially as the net asset value of a mutual fund comes down, people maybe start to pay more attention to those fees, something that I know is very near and dear to your heart.
Yeah, the fees in the mutual fund industry, I'm sorry to say, are generally pretty outrageous. And you add to an average fee of 1.5%, at least another 0.5% for the fund transaction costs inside the portfolio, which isn't disclosed separately. And then mutual funds are tremendously, except for index funds really, tremendously tax inefficient. And the index fund is going to pick up another 1.5 on tax efficiency.
You think they're going to have to come down, though, because of competitive practices and because maybe fund investors will demand it?
I think sooner or later fund investors will see the light. You see more attention paid to cost in the press. You see more dissatisfaction with the mutual fund as an investment medium in the magazines, on television. And I think the industry's got to adjust to a different era. The fees are too high, and that's all there is to that.
In addition to fees being, as your word, outrageous, a lot of people think that there are just plain too many mutual funds out there, some 9,000. What's your view on that? And I note that you guys have something like 22 or more separate index portfolios just in the equity area. Why do you need that many?
Well, you need, first, I think there are far too many funds in the industry. I mean, I don't know what one does with 9,000 funds. Now, of course, I can immediately jump to our own defense, which maybe is a little bit unfair, but you need a number of index funds because investors are getting more specialized. And some investors want the 500. My preferred index fund happens to be the total stock market, which includes large, medium, and small stocks. But some investors with a blue chip portfolio want an aggressive entry into, say, small cap growth funds. Well, a small cap growth index fund is a very intelligent way to do that. So, to a point, we ought to meet public demand. We shouldn't be creating, we as a company or we as an industry, mutual funds whose only reason for being is to appeal to a marketing need that is unsound. We ought to be spending more time in this business on investing and less time on marketing.
Section or analysis.
I think that video was from 97, so everything that Bogle says back then is probably even more applicable today. So let's talk about it in more detail. So fund lag, right? The average return of the stock index of a stock in the index lags the index return, which is in some ways just a little bit hard to understand, right? But basically what it's saying is that larger companies have performed better over time. We really don't know exactly why it's the case that that's been happening. Larger companies might be doing better because they have benefits of scale. A lot of the larger companies now are tech companies, so maybe they benefit from network economics. Or it may also be that just because of passive, right? More money flow, passive is becoming a larger part of the industry. More money flows into the larger companies. But what we do know is that active managers tend to underweight the largest companies. Why do they do that? One, it's harder for them to develop an edge, right? What do you know that 50 other analysts don't? And then two, large companies are easy to own passively, right? If I'm an investor in your mutual fund, why do I pay you to own Google, right? I can own it, through the ETF, SPY or NDX, pretty easily. And you see it. This is a pretty recent report from Morgan Stanley. I think it's from August 19th. Large cap institutional ownership. NVIDIA now the most under-owned mega cap tech stock, right? So mega, and you know, I think the first line is mega cap tech stocks are now the most under-owned in 16 plus years. And NVIDIA is the most under-owned large cap, followed by Microsoft, Apple, Amazon, and AVGO, which is Broadcom. So pretty interesting because there's also been probably some of the best performing stocks recently. But you know, what's interesting is fund lag is not a recent phenomenon, right? The average stock has lagged the index over the last 20 years. So if you look at the average stock in the S&P versus the S&P 500, there's been about a 0.9% annual lag. In the NASDAQ, an average stock in the NASDAQ has underperformed the index by about 3.3% over 20 years. That definitely adds up. And you know, frankly, the problem is getting worse, right? Over the last decade, if you look at the S&P, the lag has been about 2.9% annualized, and the NASDAQ has been about 5.3%. So here's what that looks like in chart form. SPY is the S&P 500 index. RSP is the equal weighted index, and you could see, you know, if you'd invested in one versus the other, you'd have, you know, $300 versus a little over $200. So pretty significant over time. And then similarly, if you look at the NASDAQ 100, QQQ is the NASDAQ 100, NDXC is the equal weighted NASDAQ 100. And so you can see that, you know, 10 years ago, $100, you know, would have become close to, you know, or a little over $500 in the NASDAQ 100 and only about $300 in the equal weighted NASDAQ. So that's fund lag. Let's talk about investor timing, right? Investors tend to get in and out at exactly the wrong time, right? They get in when only after fund managers have done well, and they get out only after fund managers have done badly. Fund managers themselves also, by the way, are subject to investor timing, right? They get bullish when the market has done well, and they get bearish after the market has done badly. What you see is the average dollar return trails the average time-weighted return. And again, this all comes back to the human tendency to overweight the latest data point, or what people call recency bias. Morningstar puts out this report. It looks at the investor return versus the return of the mutual funds, open-ended funds, and ETFs. And what you can see, this is 10 years ended December 31st. So the average investor made about 7%. The funds they were invested in made a little bit over 8%. So there was a gap of a little over 1% annual. And that gap, you know, that persists over time. So you can see it's anywhere from about a little over 1% to 1.5%, pretty consistently. And then let's talk about the third invisible cost, which is capital gains taxes. So first, there's short-term capital gains tax. So those are taxed at ordinary income. So if your tax bracket is, let's say, 37%, and you own a stock for less than a year, that's the tax you'll end up paying on the gains that you might have. If you hold a stock for longer than a year, you might be taxed anywhere from 0 to 20%, depending on your tax bracket. What's important to know, though, is capital gains taxes are only owed if an investment is sold. And we'll come back to that in a minute. And you know why I talk so much about capital gains taxes is I think they're probably the biggest drag on investors' net returns. Importantly, there are ways to avoid or reduce capital gains taxes. So number one, you can pass your investments on to your heirs at death. It's what we call stepped up basis. So if I bought a stock for $100 and it's now worth $200, if I decided to sell it, I'd owe 20% on the $100 gain, so I'd owe $20. If I died and I passed on to my kids, their cost basis would be $200. They could sell the stock for that money and not owe Uncle Sam a dime. You can also gift assets to individuals in lower tax brackets. So if you're in a high tax bracket, and let's say your kids, maybe they're starting off, they have a lower income, they might be in the lower tax bracket. So if you could sell, you could give it to them, maybe their tax would be, 0 or maybe 10% instead of the 20%. You could do something called tax loss harvesting. So if you have gains and you have losses, you can kind of sell both and they'll use them to offset. You could donate appreciated stock. I know for a fact that Stanford would love appreciated stock. So if you had bought a stock for $100 and it's worth $200 today, you could donate that $200. You avoid the capital gains tax, so you don't pay the $20 on the $100 gain that you made. And you also get a tax deduction. So if you donate $200 and let's say your tax rate is 35%, you get a 7%, you get a $70 reduction in your taxes. So it's a pretty powerful way to make charitable contributions. You could also do a strategy called borrowing against the portfolio, or what a lot of people refer to as buy, borrow, and die. I also refer to it as the Jeff Bezos. Buy, borrow, and die is very simple. Instead of selling a stock, you borrow against it. You don't pay any capital gains because you didn't sell the stock. In fact, you can actually deduct the interest expense on the debt that you borrowed. So instead of selling the stock to maybe go on a vacation or something like that, or in Jeff Bezos' case, buy a yacht, you borrow money. The reason I call it the Bezos is I actually think there was a year where Bezos had basically no reported income, and it was a year where the government handed out stimulus checks, and he got a stimulus check. So complain to your congressman about that. What's interesting about it is the die part is, you die, you pass on your stock to your heirs. They get the stepped up basis. They sell the stock. They don't pay any capital gains. And then they pay off your debt for you. So that's why it's called buy, borrow, and die. Now, there's also different accounts that are tax exempt, so IRAs, 401ks, things like that. And then there's certain types of investors, institutions that are tax exempt, like charities, endowments, and foundations. So let's just talk now. Let's just go through, I said we'd go through the numbers in, using more modern numbers than what Bogle talks about in his paper. So first one, first example we'll use is just the base case, passive index, no capital gains. Let's assume a 10% sort of market return. There's no fund lag because you're not picking stocks. There's no trading costs because you're not really trading. There's a management fee, 9 basis points, 9 cents per $100. That's what Vanguard charges you, I believe, right now. They don't charge you a performance fee. And, we're going to assume you don't pay any capital gains at the end of 10 years. You either die, you pass it on to your heirs, or you donate it to charity or something like that. And in that scenario, what's your return? Well, your return is 9.9%. Very simple. 10% minus the 0.9% management fee. And here we could see kind of what it looks like. So you start off with $1 million, you make 10%, that's 100,000. There's no fund lag, no trading costs, no, the management fee, which is $900 that you pay, no performance fee, no taxes. And here you go. And at the end of 10 years, you have a little over $2.5 million. So now let's look at, the same. You invest in a passive index, you sell it after 10 years, and you pay the capital gains. So, everything is exactly the same, except you pay the 20% capital gains tax one time at the end of the 10 years. So you don't sell anytime in between, or you don't do any trading anytime in between. And your after-tax annualized return then goes down to about 8.5%. So, the important point about capital gains is the longer you can defer paying capital gains, the less of a drag it is on your overall return. Let's look at the same table. So again, $1 million, make 10%, so 100,000, no fund lag, no trading costs. The management fee is still the same, $900, no performance fee, no taxes in year one. And this is where you go to. And then in year 10, Uncle Sam takes $314,000 away from you. And you end up with about $2.2 million. So in this scenario, you get about 88% of the return from the first scenario, with the rest going to the remaining 12% going to Uncle Sam. Let's look at a typical mutual fund. 10% gross return. Again, let's assume that the mutual fund, on average will do, like you said, active manager will do on average what the market does, but they'll have fund lag. So in this case, I assumed a 1% fund lag, which, frankly, if you look at the recent data, might be a little bit low. They have trading costs. So if you, look at on average about 15 basis points, and not a lot, but there are trading costs. A mutual fund manager has to get paid, so he's going to charge you a management fee. I think on average, the management fee is about 40 basis points now. They don't charge a performance fee, so that's good. So that's 0. And, but they do turn over their portfolio. So let's assume they turn over the portfolio once a year, and we pay about a 20% capital gains tax every year because they'll pass through the taxes to you. Your annualized after-tax net return in that case is about 6.8%. And so to do the same as the market, your mutual fund manager needs to do about 12.2%. So he has to be about 22% smarter than the average investor to kind of break even with passive. And we'll look at the numbers. So 100,000, gross return 100,000, but now you have fund lag, so you do a little bit worse. You have trading costs, you have management fees, no performance fees. You do pay taxes, and now you'll see after 10 years, you end up with $1.92 million. So in a mutual fund, you put up 100% of the capital, and you get 75% of the return that you get from investing in passive. Now, let's look at some other cases. A hedge fund where you're a taxable investor. So let's assume a 10% return, 1% fund lag. Now, a hedge fund will trade more, so let's assume they trade twice as much as a mutual fund, so 30 basis points of trading costs, still pretty low. They'll charge you a management fee. Now, the average management fee is no longer about 2%. It's about 1.4% for the industry. And they'll charge you a performance fee. So the performance fee is 16% on average. Not 20%, but still 16%. And, a lot of funds, most hedge funds are, they're turning over their portfolio multiple times a year. So you'll pay short-term capital gains, and you'll pay a 37% short-term capital gains tax. Your annualized after-tax net return goes all the way down to 3.9%. Or to put it another way, your hedge fund manager, if you're a taxable investor, has to do about 18.7% gross for you to kind of break even. So he's got to be about 87% smarter than the average guy out there, if you want to think of it that way. So here's the numbers. $1 million, 100,000, fund lag, trading costs, management fee, performance fee, taxes, and you end up with $1.4 million. Put up 100% of the capital, and you get 57% of the value that you would have gotten in this case versus investing passively. Now, if you're a hedge fund, but you're not a taxable investor, let's say you are a charity or an endowment or something like that. So same assumptions, except you don't pay any capital gains tax because you're tax exempt. So your annualized, significantly better. You get 6.1%. Your manager needs to only be back to about 28% smarter than average to break even. And so what does this really mean is that it really means that hedge funds are really meant for it to be, really vehicles for tax-exempt investors. And here are the numbers. Again, the taxes. So, still not as good as passive, but, not as bad as if you were a taxable investor. And you're getting about 70% of the value. So where are we now? So we know that costs are high. Active managers bear the costs, but maybe we'll make the money trading against a bunch of not very smart retail investors. And that gets us to our third author, Charlie Ellis. So Charlie Ellis, he started a fund a consultancy called Greenwich Associates. He was a professor at Harvard. He was a director of Vanguard, and he was chair of the Yale Investment Committee, and he authored, again, a number of books, including, I think, his best-known book called Winning the Loser's Game, which is based off of the paper we read called The Loser's Game. So what is the loser's game, right? Charlie Ellis's basic premise is investing used to be a winner's game, but it's now a loser's game. What does that mean? investing used to be amateurs fighting amateurs, and now it's professionals fighting professionals. And, he basically makes the point that there's basically much less dumb money and there's a lot more skilled investors. Amateurs are smarter now and they have access to a lot of the same information that professionals do. So what defines a winner's versus a loser's game, right? A winner's game, you win by taking action. So in the analogy he uses of tennis, professional tennis player, he acts and his outcome is based on his actions and he hits winners. In a loser's game, you win by making fewer mistakes. You keep the ball in play. You're an amateur, you keep the ball in play. And the point that Charlie Ellis makes is that the investing world has changed and is now dominated by professionals. And professionals had an advantage when the market was mostly retail investors, but again, it's dominated by professionals. And to paraphrase a couple of things that he says, the trouble with winners' games is they tend to self-destruct because they attack too many players, all of whom want to win. In just 10 years, institutions have gone from only 30% of total transactions to a whopping 70%. Now, he wrote this paper back in 1975. So the numbers are much higher today. And the professional money manager isn't competing any longer with amateurs who are out of touch with the market. He now competes with other experts. So institutions today are over 90% of the total trading volume. They use every sort of tool known to man. Charlie Ellis says, again, he's talking back in 1975 that institutions have started to develop research staff and started to tap the information provided by brokers. And if you look at today, firms are using AI, they're using alt data, they're using expert networks, they meet with management, they do sentiment analysis, they use quant tools. It runs the full gamut. And I would predict that beating the market will only get harder in the future because things like computing power and analytics now make it easier to test new strategies. And, didn't think you'd get away. There's no way I was going to not mention artificial intelligence, especially now. I think this was really interesting. This was in Barron's, I think just this past weekend. So if you look at the CFA, the Chartered Financial Analyst test, right, the pass rates have never been very high. They've been right around 50%, on either side of 50%. But what was interesting is the article just said that passing the CFA exam is tough, and AI just did it in minutes. And you can see how different AI models scored. So OpenAI got 79%, so that's a passing score, above 65%, and even DeepSeek did better than your average CFA. So, something to keep in mind. The issues are that profitable niches get discovered and competed away. So niche strategies become mainstream. I was around when long-term capital management blew up. I presume some of you guys were around then. If you haven't been, it's a very interesting story. I won't talk about it right now. There's lots of books written about it. You can find out stuff about long-term capital management. It's very interesting because I think it was a $3 billion hedge fund at the time, and at that time, the Fed felt the need that they needed a bailout. Basically, active managers are on a treadmill to keep finding new strategies, and they're probably going to have to keep running faster in the future. The dumb money is less prevalent and not as dumb anymore. So retail investors are roughly about 5% of volume. They don't set the marginal price. More importantly, they are more skilled and knowledgeable about investing. A lot more people have read Benjamin Graham, Intelligent Investor. They know more about what they're doing. But it's more than that, right? So in the year 2000, the SEC passed something called Reg FD, Regulation Fair Disclosure, which ended selective disclosure by companies. So before Reg FD, companies could call up their favorite investors, their favorite analysts, and tell them information and not have to spread it out widely. It wasn't necessarily insider trading, but it was effectively the same thing. Now you can get financial statements. You can access them over the internet. Before you had to, prove that you owned a stock and then write a letter to the company and then maybe get them to mail you an annual report. It took some time to get through the mail. Earnings calls and conference presentations are now webcast. It used to be you had to call to find out how to get on the call and listen to what companies had to say. If you couldn't do that, you could maybe read a research report, but even those were hard to get. But now, if you're a retail investor, you have pretty easy access to Wall Street research. And, most investors have institutional quality tools now available at relatively low costs. So, investors are getting smarter. The next point that Charlie Ellis makes is the default assumption in a loser's game is that any decision is wrong, right? What he says is, don't do anything because when you do, it is on average a mistake. So when you're really thinking about, is the stock cheap? Should I change my asset allocation? Your base case assumption should be that whatever you're deciding to do now is wrong. So don't, really kind of think about it. Really, the onus is to overcome the high hurdle before you take an action. Prove your decision is correct. If you want to think about it in losers tennis, the way I think about it is you only would try to hit a winner when you get a can't miss ball, right? Your opponent hits a really high short ball in the center of the court. He's way off the court. Maybe then you want to go for a winner, but other than that, you want to play very defensive tennis. And so, in investing, the way you should think about it is you only want to make an active bet when you see, what we call a quote unquote no-brainer. As you'll see, few active managers can or do invest this way. And so now, getting to the real heart of it, how can we invest successfully? So let me just quickly recap a couple of points, right? Well, number one, returns of active management before costs have to be the market, right? That was what Bill Sharpe said. There are significant costs related to active investing. That's Bogle. And active investing could still work if there was dumb money to capitalize on, but unfortunately, the dumb money is less prevalent and not as dumb. And that's what Charlie Ellis was saying. So let me add a couple more things, right? Markets are usually efficient. That's not to say that they're always efficient, but I do think that the wisdom of crowds sort of applies to markets. So if you really want to think about it, the average of people's individual guesses is usually pretty accurate. The analogy that people use is guessing the number of jelly beans in the jar. So anybody's one guess is probably going to be off, but if you average all of them together, they're usually pretty good. And that's probably the same way you should really think about markets and prices. And then let's not forget that in a loser's game, which I think most of investing is today, active investing, most active decisions are wrong, right? So the real question is, how do we stay in this outperform quadrant, right, where we want to be? That's where we. So what I would postulate is that we act only when markets are making glaring mistakes, and then at all other times invest passively and wait for opportunities. You could use an analogy of investing the same way you might want to play poker or blackjack. You would only play the really good hands, like if you're in poker and you get pocket aces, and then fold otherwise. And I know some people out there who are probably much better poker players than me would say that that's not a great winning strategy, but I'm just trying to make a point here. So basically what I'm saying is invest like this guy. He makes very few investments in any single year, only acts when he sees significant value, sits around patiently when he can't find opportunities. And importantly, and I think this is the most important part, is traditional active managers can't and don't invest this way, right? They can't wait for fat pitches, right? Their clients want to see them taking action. They can't build up cash or index while waiting. People say, why am I paying you, right? Over diversification hurts their performance, right? Do you really have 50 or 100 good ideas? And most importantly, they're deathly afraid of short-term underperformance. And we'll talk more about this next week. So the good news is there are ways to invest profitably. I spent today really talking about the problem so we can solve it. The point that I want to leave you with is that traditional approaches are unlikely to succeed in the future. But next week, what we're going to talk about is how markets really work, and understand how traditional investment managers think and act, and use that information to see how we can find opportunities to exploit. So the main point is that investment decisions bear a high burden of proof. There are high costs of active investing, and therefore, if you want to be a great investor, you're going to act rarely and opportunistically. So I am going to stop there. Let me stop the share right now. I saw there's a couple of things in the chat. I couldn't really see the chat while I was speaking, so. But let me just open it up now. We're right at about the 1 hour mark, so I think I timed this one actually pretty well. I know I went through it pretty quickly, so please let me know if there's anything I need to clarify on. Happy to do that. But really, I want to open it up to you guys now.
Hey, Jay, I just have a quick question regarding to CFA. And you were looking at the AI can do much better than a human being, which means the CFA probably is not worth to taking. And I just like to know what's your taking on.
I mean, I have a CFA, of course, from many years ago before AI. So, yeah, I mean, look, I think this is one of those existential questions that I think we face, not just in investing, but really across a number of industries, is not just where is AI today, but where is it going to get to over the next, 5-10 years? And what does that mean? I have a kid who's about to start college in a few years, and frankly, I don't really feel highly confident if I could give her advice on what career paths to pursue, because I'm not sure what AI is going to make obsolete or not. So, what I would say is that I think there's a lot of, the CFA is not bad in the sense of it. If you can pass the CFA test, you definitely are one of the top performing humans in the industry, right? And then I think having the CFA plus AI probably will put you, at the leading edge of the industry. But it is one of these things where I think, I think it probably goes without saying that we all have to stay kind of on the, we can't let our skills get rusty in this new era.
Yes. As a retail investor, you think we should just get the CFA level 1? That's enough?
Yeah, I think so. Look, I mean, I will even go so far as to say, well, see what you think after this whole class is over, because, depending on what you want to do, maybe you'll learn enough in this class that, you may not even feel the need. I think investing has become overcomplicated for a lot of reasons, mostly because it serves the benefits of the industry. But at the core, I think rational investing is actually very simple. And so if your goal is really to invest for yourself 100%, you may not even need the CFA.
Okay, thank you, Jay.
Yeah.
One more maybe is not fair for you, but I just want to ask. I'm sorry. Yes. There's another course, a similar name is called the Value Investor from Columbia. What's the difference from yours?
I don't know. I don't know what that class necessarily is. I think, when I've looked at other value investing classes, I think they've been more, like I said, I think more accounting and financial statement analysis focused, or more like sort of competitive strategy classes. Stanford Continuing Studies used to have another value investing class by, I think, Kenneth Marshall, and that one was much more focused on doing like 5 forces analysis and things like that. If you look at the syllabus for this class, what we're going to be doing is much more different. It's much more of a multidisciplinary approach, like I said, about how to think about investing, and then really then using the last 3 weeks of the class to go through, real life case studies. So I think hopefully it's more interesting, more practical. Like I said, I think there is value in accounting, but, I think for most of what we do, you don't need to know all the, the finities of accounting and this and that. I think it's all helpful. But, when we really come down to a lot of the things that we've been talking about, I think we can really simplify investing and still be very successful without getting too caught up in a lot of detail. But I think a lot of those other classes, not to say that they're not also worth taking. I just think they have a different approach and trying to talk to a different audience.
All right, thank you, Jay.
I see a hand, Suraj.
Yeah. So, yeah, hi there. My question is more around like since they just shift towards like more and more people are doing like S&P 500 like index investing, right? So in future state, like if this trend stays and it like just keep going up, like more and more people do it in the future. So does that mean like is it going to create more market inefficiency and hence like more investment opportunity, or does it means like it would mean like lesser opportunity in the future state? Like what?
Yeah, it's a good question. I don't think anybody really knows the answer, right? On one hand, what Bill Sharpe was saying in his video, right? Like we don't want everybody to become a passive investor, right? Because if they did, then there's nobody actually doing the work to say, which companies are really cheap and which companies are expensive. So in that case, yes, you would create more market inefficiency potentially. The problem is that how do you say something is inefficient if it never reverts, right? Meaning if the market becomes fully passive, everything is inefficient, I don't know, Microsoft is at $1 trillion and Apple's at 0, and but it stays like that because if 99% of the money is all flowing in that direction, like how do you ever arbitrage that that mispricing, right? Now, some people would say, well, there's companies can choose to go private or activist investors or certain things would happen. But in this case, if most of the market is passive, you won't have those kinds of opportunities. So I think the answer is we don't really know, right? I think we don't really have a good sense right now. I think the interesting thing about active is, even though people talked about the death of active, is people still want to go into active investing. People still want to work in mutual funds and hedge funds. Do not purely dismiss what Bill Sharpe said about getting nice football tickets and things like that. Like there's still a lot of attractions that people have to the industry. So I mean, passive is obviously taken off, but I think there will probably come a time where active investors do better. And the whole focus of this class is really to show and teach you guys how you can be active investors in a world where passive is dominant and still make money. But it can't be acting like every other active manager acts today, because that's not going to be a winning game. Christina?
Hi, Jay. I have a question. I actually posted here as well, which is I read the article about this being a loser's market. And if it's the loser's market, your point is that you actually don't make a move unless you're super certain. So are you going to cover ways to properly value a company or investment? Because right now, like, people are flying blind and you can come up with like a lot of different assumptions. Are there rational ways to methodologies to do that?
Yes. Yeah. Well, so one, what we're going to talk about, I think a couple classes from now is we're going to talk about how to think about things like intrinsic value, and the traditional ways of calculating intrinsic. Like, first of all, what is intrinsic value, right? What does that mean, right? And then how do we calculate it? And then there's a lot of drawbacks on how people can think about intrinsic value, but I think there's a really good, useful way, practical way for people to also think about intrinsic value. So we'll talk about that. And then the other thing that we're also going to talk about is margin of safety, right? And so people always throw out the term margin of safety as some sort of general qualitative view of like, oh, buy something at a discount, right? But if you don't know what something's worth, how do you know what a discount is and this and that? And what's interesting is, Benjamin Graham had a very, if you go and read what he wrote, again, he wrote it, many, many years ago now, over 50 years ago now, right? But he wrote, and there was actually a very practical way he thought about margin of safety. And so I think if we look at those two things, thinking about intrinsic value and margin of safety, kind of the core of what, underpins like Buffett and most value investors, I think there's real practical ways to think about it. So yes, we are going to go through it. This is not like like I said, this is not a class where we're going to be, building, large three-statement financial models, doing, showing you how to build a complicated, DCF that, has so many sheets in Excel and, makes your computer run slow or anything like that. I don't think you need that, right? The world's greatest investor, can pretty much analyze stocks, in his head. And, we might not be nearly as smart as he is, but I do think that there are certain techniques that we can talk about that, that we can use in our own daily lives. So that's what this class is built on. David?
Hey, thanks for a great first lecture. My question is, my issues with passive investing for myself is the indexes always seem kind of expensive to me. So it's always hard to like kind of dive in. And you seem like, you kind of wait like years, decades before it seems like reasonable, like to have an opportunity just to put money into, the index where you don't feel, I don't know, you always feel like you're worried about you're going to go into Japan like in the 1980s, where it's 30,000 takes you 7 years to get back even.
Yeah.
Are you just dollar cost average in, I guess, and just don't worry about it?
It's good because that's actually going to be one of our topics for our next class. So we're going to talk about things like, stocks, not specifically, but like how to deal with like things like volatility and things like that. Because, the reality of it is that I think that, the way I think most of us should think about investing is really what is the opportunity cost, right? So if tomorrow, you could buy the US government treasury for 10 years or 30 years and make 10%, right? You should probably sell every stock you could, right? Because, I'm not sure if the market will, the market may do 10%, right? That's historically been the average, but it's not going to do, you're going to do that maybe with less risk and, think about taxes and all that other stuff. But, here we are. And I think what befuddles most investors, or what frustrates people like you and me, is that we look at multiples and we look at where things traded in the past and we say, well, wait a minute, it's just too high now, right? And, again, I think that the problem with that is, well, a couple of things. One of them, which we'll talk about next week, is the markets themselves are very short-term oriented. But the problem is also what's the opportunity cost, right? Because, you could sit here today and maybe you could put your money in a money market fund or something like that. You maybe make 4% or something like that, right? But even if you think the stock market is high today, and maybe you're not going to make the 10%, 11%, 12% that you've made historically, maybe returns are closer to 8%, right? Still would rather have 8% than 4%, right? And, you don't want to have your cash sitting under your mattress because, inflation is going to eat away at the purchasing power. So sometimes it's just investors are faced with what's the least worst choice, and how to think about it from that perspective. But I think, you'll see, I believe it's next week. There's actually an interesting analysis. The paper is called, even God couldn't beat dollar cost averaging. And it's basically saying that, like, if you knew exactly when the market was going to crash and you invested purely at the bottom and you waited out every other time, you still did worse than if you just dollar averaged into the index. And it's pretty remarkable. So, again, stay tuned, but I know exactly the frustration that you talk about. But, the other thing I would also say, David, is I think a lot of us as investors, we lose the long-term picture, right? I presume most of us have either been investing for at least some period of time, and hopefully are going to be investing for longer periods of time. And the market tends to shake out people, right? I always use the analogy. It's like the mechanical bull in the bar, right? It's always trying to shake off the people who are the weakest hands. And when you step back and you really look at it, right? If you can invest with even a 5-year horizon, a 10-year horizon, a 15-year horizon, right? The chances of you losing money, are very, very low, right? Even if you invested at the peak of the tech bubble and you sold at the bottom of the GFC, right? Your net return was like negative 1%. And that's, you're buying in at the extremes of one and you're selling at the extremes of the other. So, my only other piece of advice is really sometimes you just need to step back and, people get caught up in headlines of, tariffs or government shutdowns and this and that, and, lose the longer term focus. But over long term, compounding, even if you're compounding at 8%, right? That means you're doubling your money every 9 years. Pretty good.
Thanks, Jay.
Yep. Peter?
Yeah, so I'm wondering if there are comparable studies on, and I don't know how many funds are all like this, but basically playing buyout roulette, looking for opportunities, special, unique opportunities that can arise in the M&A context. If you make a smart call, get in on a company that you think is maybe underappreciated in a particular. I think it implies perhaps a degree of knowledge of specific markets that would be hard to do on a sort of a random basis. You'd have to really understand where, for example, I mean, nobody would have, if you'd had an opportunity to buy OpenAI at its first venture round price, and you'd said, this company is going to, go to the moon, and so you bought as much as you could get, obviously your return is going to be higher than somebody that made the same bet on some company that, fizzles out and never even gets bought. But so I'm wondering if there's data on those type of investment strategies.
It's a good question. I nothing that I don't know if I've seen anything specifically like that. When you were first asking, I thought you were asking more about like risk arbitrage, merger arbitrage, where companies are getting acquired and things like that. But it sounds like what you're asking about, Peter, is more like finding those companies that become the big winners in like venture type investing, right? Like, how do you identify who is the, who becomes like the next Amazon or whatever? Am I understanding you correctly, or who becomes the next OpenAI?
Yeah, I guess the probably the closest thing would be a lot of people avoid IPOs like the plague these days, but somebody could say, I'm going to buy IPOs. Maybe I'm going to buy all IPOs, figuring that, but if you did that, I don't think that's a winning strategy. But if you tried to pick the IPOs, yeah, which one's going to be the next Amazon? But again, it's like,
yeah, I mean, I don't know offhand if if there's a good I haven't seen any good analysis on how and I don't think anybody has written down how to pick the next Amazon, because frankly, if they did, I'm sure it would be a bestseller and everyone would read it, and then everyone would arbitrage it away. There is a book actually here, it's sitting on my shelf right now. It's called 100 to 1 in the Stock Market, and basically what the author did is he looked at every stock that became a 100 bagger over some period of time, and what were the common characteristics of those companies and things like that. And basically it was companies that are creating a lot of value for customers, small company in a large market, large runway, spending a lot in terms of R&D, innovation, all those sorts of things. And then just really, investor patience and being able to hold those companies for a very, very long time. But let me ask around and see if it's an interesting question, Peter. If anyone has done kind of it sounds like more like what are the characteristics of the big winners. I can't think of anything else besides that book, but maybe I'll find something else between now and next week, and we can talk about it then. Judy?
Yeah, thank you, Jay.
Okay.
I just have a quick question. You talked about investing for the long term. We talked about passive investing today, but I want to hear about your perspective on the markets, like what happened today. There was a government shutdown. You mentioned not to look at the headlines. I know the jobs number, they were saying how the private sector shed some jobs, and so people are thinking that the interest rate will continue to fall. But my question is, do you think there is too much optimism and a correction is due? Because I just feel very hesitant to, enter as everything is continually going up. So I'm just curious what your take is on how the market's
so I mean, there will be a correction. I don't know when one will happen. I don't think anybody knows when one was going to happen. I just know that, over time, there will be corrections. Actually, again, I'm going off the top of my head. I think it's next week. I think we're going to be reading a piece by Peter Lynch where he talks about this specifically and how, the best, Peter Lynch makes a point that, more money has been lost, preparing for recessions than probably been lost in the recession themselves. So, people tend to take defensive actions and then they miss out on the markets. And, the funny thing about markets is everyone says, well, X should lead to Y, right? We have a government shutdown, the market should go down, right? Market was down this morning, then it went up. How did that happen? Why did that happen?
Yeah.
The reality is that, for most people, for most investors, and again, we're going to talk about this in one of the later classes, is, we always tend to think about stocks as long-term investments. But most people tend to treat stocks as if they're, really short-term investments, right? Because it's like, hey, all I'm doing is I'm buying the S&P today because maybe there's a government shutdown, but maybe I think that there'll be some good news tomorrow, and so I'm going to buy it today and flip it tomorrow, right? Everyone is kind of flipping on the very short term. And so, the markets tend to react to these headlines of, oh, they're talking about maybe, creating some, coming to some agreement. Maybe the shutdown will be short-lived, things like that. So, I will tell you, and we'll talk about this in later classes, is we, as I think, we're all here, we all try to think about things probably on a fundamental basis. And I think we can sometimes get too frustrated trying to think about the market fundamentally when we really need to think about what the market really is, which is a bunch of people, speculating really is what it comes down to. And, I'll talk about it a lot more next week, but, and this is not a comment about the market right now, right? I think markets in general, when they're liquid as the way stocks are, we're talking about stocks in this case, right? But the way stocks are, liquidity tends to invite speculation, right? Because of the very simple fact that if something is liquid, I can make a very short-term bet on it. And if I'm wrong, I can get out and not lose a lot of money. And I'm not stuck with something for a very, very long period of time. So maybe that's a little bit of a long-winded answer, but I think that, instead of spending too much time worried about the market, maybe coming down, again, I say go back and look at the longer term picture and think about what are reasonable returns, and then what's the opportunity cost, right? Because we could be in a scenario, right? And again, people talk about it. Are we in a bubble? Are we in an AI bubble? Are we in this and that? I just like to remind people, again, I'm older than probably a lot of people on the screen, but Alan Greenspan made the comment about the markets being irrationally exuberant. We all remember that, or most of us remember that. What most people forget is he made that comment in 1996. And the market went up 20%, 25%, 30%, So there was a lot of time that, if you had listened to Alan Greenspan and got out of the market in 96, the next 4 or 5 years would have been quite painful for you as you sat on the sidelines and, your neighbors and your brother-in-law and everybody else got wealthier. So we'll talk more about that, but I think when some of the things we talk about next week, I think will be most interesting because it really does do a good job of showing why timing the market is it really doesn't pay. It's more about just kind of staying the course more than anything else. And even when you get into the market at a high price and things like that, it really doesn't impact your long-term returns nearly as significantly as you think.
Thank you. That was really helpful, Jay.
Yeah, sure. Cameron?
Hi. So I was wondering, you talked a bit about like the friction that comes from selling securities, the tax friction and how that, makes it so that passive investing is superior. How does that apply when you look at like diversified portfolios and rebalancing and the tax friction that you get from that, but the benefit that you get when obviously like when like there's a market drop and you have more bonds, you can sell the bonds and then buy into equities that way. And that rebalancing is like a natural mechanism to buy low and sell high. And so what do you think about that from the tax friction standpoint? Does passive investing not work as well in like a balanced portfolio where you need to rebalance, or are we only talking about like indexes and stocks?
Well, okay. So again, I'm going to sound like a broken record because this is all like, things on the come. But one of the pieces we're going to read by Peter Lynch, he actually talks about bonds and why you should probably never own bonds, and why you're better off in the, especially if you're, relatively young, you're probably better off just owning stocks 100%. So the question is, well, if you, what's the benefit of rebalancing, right? Well, again, I think it really matters what your starting point is, right? Because if, let's say, stocks are expensive and bonds are cheap, then, maybe they both go down and you rebalance from stocks into bonds, right? But what happens when stocks and bonds are both expensive, right? And then rebalancing from one into another, people have this mistaken perception that bonds are riskless or less risky than stocks, right?
They're less correlated, right? That's kind of the concept. They're not as correlated, right?
They're not as correlated, but you can lose as much money in bonds as you can in stocks, right? It's just you're taking a different form of risk in terms of interest rates and things like that. But there's long-term bonds do have a fair amount of volatility, as people learned when when the Fed took interest rates from 0 to 9%, or inflation went to 9% at least. So I think the real question I think you're trying to answer is, how do you manage volatility? And again, we're going to talk about that, but I think what we'll see is that the reality of it is that more people feel that they need to manage volatility than they actually need to manage volatility, right? Because if you look at how markets behave, then what you'd realize is that if you're not a consumer and if you're a net saver over some period of time, the volatility shouldn't really impact you. It might impact you mentally because you don't like to see your portfolio value go down, right? But you're not consuming out of that portfolio. And so really that volatility is just, a mark on a paper that, if you can, again, keep that long-term perspective in mind, probably matters less and less.
Only if you lean on the portfolio does the volatility matter.
Correct.
Yeah. Okay.
Yeah. If you need the money, right? This is always the point, right? If you need the money over the next 5 years, right, then you shouldn't be in stocks, right? Because nobody knows what can happen over the next 1, 2, 3, 4, 5 years. There's enough data to say that over 5 years, over 10 years, over 15 years, over longer periods of time, the risk in stocks becomes a lot less.
Yeah.
So,
even if you needed the money, you could borrow against it, like Jeff Bezos instead. So you don't need the bonds then either.
You could. The problem, here's the problem with borrowing, right? I will tell you, because I lived through this, right? I saw stocks trade at less than the value of the cash on their balance sheets during the GFC. And so you're like, wait, and they were not burning money either, right? So, markets can go to very extreme levels. And if you borrow, especially if you borrow against the full value of your portfolio, which I do not recommend anyone ever do, but if you ever did that and markets really crash or there's a flash crash or something like that, the problem with that is, you'll get a margin call and then you'll be forced to sell at the absolute time that you probably should be buying, right?
Yeah.
So, leverage is, what, Munger once said, liquors, ladies, and leverage were the three causes of man's ruin, something to that effect. And he said I only added liquor and ladies to rhyme with L. Leverage is great when it works on the upside, and it's terrible when it's on the downside. So it is something to think about. But again, this is where I think, it again comes back to, what is investing, right? Investing is putting out money today for long-term returns, right? Not for, what you think you might be able to do in the short term.
Yeah. And then you said that you can write off the interest on the leverage. I always thought that's only if you invest it. So you said Jeff Bezos, you can live off of it and write off the interest?
So again, I'm not a tax expert, but yes, I think the answer is yes, because the way the IRS views it is because you borrowed money against an investment security, that is investment, investment debt. And so that's, you can write that off. But again, before you do that, consult your own tax advisor.
Fair enough. Thank you very much.
Yeah, of course. Charles, do you have another question?
Yeah, I have a quick one. What do you think about the annuity?
What do I think about annuities?
Is that the investment, or is it's kind of really passive stuff? I mean, it's not recommended because people want to.
I don't recommend annuities. Again, people might have specific financial circumstances and things like that, but the people who are selling annuities for a reason, and to me, it's okay. Let me give you the simple example, right? Because most annuities are sold by insurance companies, right? So if the way I think about it is, insurance is by definition a losing proposition for most people, right? Because it has to be, right? Because insurance companies need to make money. And so, the costs that you personally should insure are the ones that, if something bad happened, would be financially destructive to you, right? But people talk all the time about what deductible should I have on my car or something like that, and if the choice is between $3,000 and $4,000 or whatever, right? I think that's an example, or like trip insurance if my trip got canceled or something like that. Like those are examples of insurance where if something didn't pan out, it would be painful, right? But it wouldn't be like financially destructive to you, right? Whereas like health insurance or something like that, right? If you had cancer, could be financially destructive to you if you didn't have insurance. So the way I think about it is you should insure against the big risks, right? So going back to the question on annuities, right? Annuities are primarily sold to people because the rate of return on the annuities is less than the rate of return that people expect to get in the underlying asset portfolio, right? So if you want certainty, if you need certainty, then that's one thing. But again, I think it really matters what your time frame is, because if you have a long enough time frame, and if the short term doesn't matter as much to you, if you're not trying to bridge from here for the next 5 years, let's say, and you might be working or you have other sources of income or whatever, then I would not necessarily sacrifice the little returns that you get from an annuity versus the returns that you get from whatever the annuity is investing in underlying.
Yeah, thanks so much. Yeah. If we have time last, what do you think about option trade? I mean, option trade is kind of really, people buy like a leap call, right, instead of buy a stock because it's cheaper, it's leverager, and if the timing is right, they get a really good return.
Yeah, if the timing is right, you can make a lot of money, and if the timing is wrong, you can, I mean, people tend to have this perverse view of options because they're like, oh, I'm only putting up a small amount of money, so if I lose all of it, like, who cares, right? But the problem is if you keep doing that over and over again, you're going to have a bigger problem, right? So, again, this goes back to a little bit about what, we were talking about with Charlie Ellis in his case, is that when you're trading options, or when whoever's trading options, right, who are you trading against, right? And I think what you'll end up seeing is that most of the time you're trading against, Wall Street banks, sophisticated quant hedge funds, people of that sort. And so the real question you have to ask yourself is, why are they selling this option at this price? Or why am I able to buy this option? Or why can I sell this option at this price? And, be very skeptical unless you have a specific view or specific reason why you think, a certain stock is going to go up and down and this and that. If you've traded options, you'll also notice, and again, this is a little bit of market commentary, but you'll also notice that stocks always trade really funny around option expiration dates and around option strike prices. And there's always this question of, like, are there, option sellers, market makers who always try to keep the price below a certain strike or above a certain strike right when it happens. And so it becomes, less profitable than you necessarily think. Look, if you have a very strong reason to understand a directional view, and, the problem with options is not just you have to get the direction right, you have to get the timing right also. So you have to say, look, this stock is going to move on this date or by this date by this amount, and I'm going to make up the premium that I'm going to pay to buy the option. If you have that kind of information, then yeah, options could still make a lot of sense, right? Because, you do get a lot of leverage, but, you have to understand that you're also, risking, you're still losing 100%. You might be losing 100% of a smaller dollar amount because you're only putting up a small amount of premium, right? But you're still, your percentage loss is still quite high if it happens. So maybe that's a long-winded way of saying what I think, but,
yeah,
options are kind of just like, I don't know, playing the lottery, but maybe a little bit better than buying Powerball tickets.
It's like a drug, maybe. I don't know.
Yeah.
Thank you.
Yeah. Judy, did you have another question?
Yeah, sorry, a really quick question since you guys were talking about options, and I know we're over time. I just want to quickly ask about fixed coupon notes. Just heard a friend talk about that, and I know it's a type of option trade, but it manages risk better. So I was wondering, it just sounds like
I'm sorry, I'm not even familiar with it. What's it called? Fixed what?
It's a structured note, fixed coupon note where it kind of. So what happens is, let's say you're buying Apple, and so I think it's something like you buy it at a certain. So for 1 month of the period, if it doesn't fall, let's say Apple's 300, and if it doesn't fall to 200, then you're making 10%. So you're getting that 10%. It's kind of like a bond. It works like it gives you 10%. But if it, let's say it goes up to 190, then you're buying it at 190 equity price. Then you're actually buying that, and then you have to hold on for a certain amount of time and then see if it goes back up. So it's working like a bond, but then it becomes an equity if it falls to a certain level.
I'm really not familiar with this, so Judy, you're totally opening my eyes. I'll look at it for the next week. What's it called? Fixed coupon
Note.
Fixed coupon notes. Okay.
Yeah.
Fixed coupon. That's easy enough to remember. I don't know, but here my only point is who's selling this, right? Like I think because again, remember what I think Bogle was saying at the very end of his video, right? Like there's a lot of marketing that's happens in our industry, right? So if this is really good for investors, right? There's somebody on the other side of this, and somebody's taking the opposite trade or making the opposite bet. And so really, and I think this is a good lesson just in general is, when you're buying a stock, somebody's selling a stock, right? For every buyer, there must be a seller. For every seller, there must be a buyer, right? Yeah. And so it really behooves you to think about who's on the other side of the trade. And so, and if these are structured products, right, who's on the other side of the trade? It's Goldman Sachs, it's Morgan Stanley, it's JP Morgan, it's whoever. And so maybe they have some other rationale or something else that they expect to do. So I don't know. I'll look into these fixed coupon notes. Like I said, I'm not familiar with these structured notes, but maybe I'll get smarter over the next week and we can talk about it next week.
Thank you.
Okay, we are a little bit over, so I appreciate everyone staying on extra. I don't see any other questions, so I'm going to say that I think that's the end. Thank you guys. This has been great. This is literally my first time teaching, so thank you for all the patience with all the technical issues and everything else. I'll try to get it all smoothed out for next week. And please, feel free to use Canvas, send in questions. It could be questions, like I said, it could be questions about the readings, questions that, come up in between on other topics. Love questions, and we'll go from there. And I look forward to the next 7 more weeks together.
Thank you.
Okay. Have a great night, everybody. Thank you so much.
Sorry, Professor, I came very late because I miscalculated the time.
Oh, hi. Yeah, no problem. What I was going to say is that I think they're going to put up a recording of the class on Canvas under the Panopto, so you can watch the recording. And then, if there are any questions that you have, I'm happy to answer those questions. Just, you can shoot me an email, or you can add any questions into the discussion portion of the week, the module in the week.
Okay, that would be great. So it will be same time, like I'm from Sydney, so it's like 12:19 p.m. now. What is your what time do you start classes like?
So the class starts at 5:30 p.m. Pacific time, US. And I'm in New York, so right now it's about 10:20 p.m. In New York.
So you started class 2 hours before, or?
We started class, it's an hour and a half class.